Hello, this is Tyler Chanelli, CEO and founder of Option Trading Coach and Options Trader Club. And in this video, we're going to talk about trading options into an election and how you can position yourself to either A, learn how this can benefit you in the future, or B, how you can take part of this potential very rewarding situation right now. So first of all, volatility is at 2-year lows. This is because the markets have become rather complacent. We had a very large spike of volatility in the beginning of 2016 when the markets had a very strong sell-off in January. As we finish up the summer of 2016 and head into the final few months of the year, there is a lot of things happening. Of course, we have the election coming up, and there's probably going to be an increase in volatility. And I'm going to talk through this here. So the VIX index is the gauge of fear. So when fear is relatively low, that means the markets are continuing to trend higher. People are not scared to sell stocks. They're normally buying stocks. However, when fear starts to rise and uncertainty comes into the picture, like going into an election or having problems with terrorist attacks or overseas, instability with banking and so forth, then you'll see fear start to increase and people sell stocks and they put their money in safer asset vehicles like bonds and so forth. So the VIX index is bouncing off a strong support level, like a multi-year support level at roughly 12. And I'm going to show you the chart here in a minute, but you need to understand that volatile markets occur during these periods of uncertainty, which we can very likely see finishing out the 2016 year. And there are many ways to trade volatility. So you have the VIX futures / VX, and that's probably the most advanced and aggressive way to take part in a rise in volatility. However, if the VIX futures, or say they're trading around 15, if they went from 15 to 16, and that tied up, say, $7,000 in margin to buy one futures contract, you make $1,000 a point. Now, you can use options on the VIX, VIX, or the UVXY, which is a leveraged version of the VIX. And then you have the VXX, which is the S&P 500 volatility gauge. And then you have a leveraged version of that known as the SVXY. And we're going to look at all of these here shortly. So we're going to analyze charts to see some probable price levels and utilize the visual standpoint to determine strike prices and also cultivate smart trading strategies. So there are going to be 3 different option trading strategies, all defined risks that we're going to discuss on how you can partake in this potential increase in volatility and how to profit from this situation. So this is the VIX chart. This is actually going back through late 2014. So this is about a 2-year view. And you can kind of see what I was talking about here. This major support level that goes all the way from 2014 through parts of 2015 and all through 2016 is right around 11 or 12 on the VIX. So if we do one more view and do a 5-year weekly, you can kind of see this a little bit easier. And it's always effective to draw some trend lines and so forth. So I'm going to just go ahead and grab a quick trend line here and show you what I'm seeing. So if we take this base, and you can kind of see how it hits multiple times through 2015, 2014, even in 2012 and 2013. So this is a very critical level that we could be potentially bouncing off of. And it looks like we are from a multitude of technical analysis standpoints, through some bullish candlesticks, through a lot of different oscillators and trending indicators. And also this spike in volatility right here, that was the China fallout in August of 2015. So this was showing you how we hit a high of 53 and then we hit another high around 25 on the Brexit vote, which was back in late June. And then in the beginning of 2016, when the market sold off really strong, we saw a high of about 30 or so on the VIX. So what I'm saying is, as a self-directed trader, you have the responsibility to come up with smart trading ideas, and I think this is one of them for a multitude of reasons. Going into the election, there's a lot of rationale that we're going to see some uncertainty and people are going to be fearful with a change in command through that whole process, and getting ready for this is step 1. Step 2 is determining the strategy that you want to allocate. And there's going to be 3 strategies we're going to talk about. One's going to be very conservative, one's going to be moderate, and one will be a little more aggressive. So the first thing is the VIX and determining where this can go. So if we're trading around 13 right now, and we zoom in a little bit, we can see on a 1-year daily chart, trading back up to 15 or even 18, 20 range is very conceivable. I mean, we hit about 25 after the Brexit vote, which was a very volatile couple days, and then we really leveled off and the markets continued to trend higher. So to show you this relationship and really give you the standpoint that you need to understand the intricacy of this, and this is a little more advanced if you're just getting started, but bear with me because this is something that could be very effective for you to get comfortable with. So this is showing you, I'm going to do the same exact 1 year daily for each. We'll do a 3 year daily so that you can see the full picture here. So 3 year daily, you see these large spikes of volatility like back in August of 2015. August of 2015 is this huge sell-off right here. So if we zoom in just a little bit now, since we have our standpoint here, you can see that first big spike is this massive drop from 210 to 185 on the S&P 500 ETF or SPY. And now if we zoom in just for 2015 through 16, like the last half of 2015, you can kind of see side by side when volatility starts to rise, like back in December of 2015, we were around 17, 16 on the VIX, traded up to about 25, 27. So what happened there? December of 2015, the markets sold off pretty strong. So this is showing you that period right here is when people sell stocks, fear rises, volatility increases. So if we see this large, now let's zoom in now to a recent time frame. So if you see from June through August, you see this was the Brexit sell-off right here, which is reminiscent of this spike in volatility. And then as this market continued to slowly trend higher and just making new highs on relatively low volume now, we haven't talked about that yet, but you can see that this volatility just really kind of collapsed and got cut in half, really, even more. So it went from 25 down to a low of about 10.50 or 11. So right now we've hit some support. It's starting to bounce off of this, and it looks like it could definitely head back to 18 or 20. And that would mean a sell-off could be very probable in the S&P or the overall broader markets, which maybe taking a 5% reduction on the SPY would put you around 210, somewhere around that support level perhaps. So that's kind of how you start out, is you get a visual standpoint, understand where price can go, and then we'll look at some more of these leveraged ETFs. So we talked about the VIX, we talked about the UVXY, which is the leveraged ultra VIX on short-term futures. So this can show you a much more aggressive standpoint. And this is one that's not for everybody, but you can see back in the Brexit vote, this index traded around 80 and now it's at 20. So this is a leveraged ETF. So this, if the VIX goes up 10%, this can go up 20% or more. And if we look at a 5-year weekly, it's pretty extreme what's happening with this. And this is something where I would definitely be careful because this is not for everybody. So this is the second one. The third one here is the SVXY. Now this is an inverse ETF. So as the market's been trending higher through the last 2 months, you can see that this has been, because volatility has been going down, this inverse, this is a short VIX that's also short-term futures, meaning when the VIX goes down, this goes up. And the reason why I like this SVXY security is because it's higher priced, the options are liquid, and you can sell premium and get a great positive theta type trading scenario, which is what we're going to talk about. So let's go ahead and stick with the first example. Oh, the last one here was the VXX. So the VXX is another trading vehicle, which is the S&P 500 short-term indice, ticker symbol VXX, and this shows you the same exact thing. So we had that spike in volatility right around the Brexit vote, and then from there we've had a pretty just long and deteriorating of this as well, going from 60 down to a low of about 35. So as we have this squeeze happening right now, it's starting to kind of bounce back up. The VXX is going to be our first trade idea. So let's go ahead and pull up the option chain on that. And it's good to give yourself time. Whenever you're trading options, you don't want to get too aggressive and do anything short-term unless you're selling. And for this particular trade idea, I actually do have a position on this, so I don't want to completely change the standpoint here. But if we have a horizon of, say, 2 to 3 months heading into the election, right now it's the end of August, heading into September, and this trade is going to potentially be something that you can take off a lot earlier than the expiration that you choose. That's important that you know that. So if we bought a call So we're trading at 37 roughly, 36 around there. So if you bought a 35 call and sold a 40 call, that's a long vertical call spread strategy that is a really smart way to minimize the natural time decay. So if we go out to October and buy these 35 calls, which I already have a position very similar to this, and then we're going to sell the 40s. And the reason we're selling the 40s is because we do not want to have an option trade or a position that's going to decay and lose money, as a lot of options do. So if we analyze this first idea, buying a 35 and selling a 40 call, I'm going to go ahead and just hide my positions. And we're going to look at this by doing 5 contracts. So a 5 lot, it's roughly a $750 trade. That's where you can see the max loss down here is right under 1,000. So this is roughly a $750 trade that can make over $1,500 if we just see a small increase in volatility heading into the election time frame, which is the 21st of October. If you wanted to go out to November, that's perfectly fine too, but there's a lot of other things that can be done to roll this if it does not get that move up to 40, which is our max profit by this expiration date. So for roughly $750, we can make $2.50 per day, and we're long the VXX index at roughly 87 shares long. So if this goes up $1, we'll make about $88 or so. If it goes down $1, then you'll also lose about $87, $88. This keeps changing on me. So this is really important because this is a smart strategy. This is a conservative trade. The most you can ever lose is your debit. So if this was allocated, 156 is basically the cost basis for one lot, $1.56. Of course, you standardize that to 100 shares of stock, and 156 times a 5 lot is exactly $780. So I'm going to just lock that at 156. So for $780, you have the opportunity to make roughly $1,700. And the way that you calculate that profit is you take the spread width and you subtract the debit. So roughly $3.50 is your profit potential. So 350 times 5 is about $1,750 in profit that can be made if this VXX starts to increase and trades up to 40 or above by the October expiration. You can definitely sell it before or scale out. Those are things that are talked more in depth inside the Options Trader Club because we have a very similar position on like this. So that's the first one. And if you want to be more conservative, then you can just go ahead and come down to the 30 strike and sell the 40. So your break even is going to be at 30 and much higher theta too, higher cost basis. But say you did 2 of these for $870, you're going to have a little bit more positive theta. You're risking roughly the same amount of money, but your upside is a little over 1,000. So about $1,200 is your max profit. However, it doesn't have to move as much to make that max profit. I mean, it does have to go to 40, but the break even, because we came down and picked a more conservative strike price, the cost basis of $434 on top of that $30 strike, our break even is right around $34.50 roughly. So that's a smart trade. That's a trade that I think going into an election time is something that could definitely benefit you. Another idea is to sell a vertical call spread. So on the SVXY, that's the inverse ETF. And I want to show you real fast the VX futures. These are the CBOE volatility futures. And you can really see a lot of insightful support and resistance levels as well as trending situations right now and volume. And a lot of these underlying ETFs, which are very popular, exchange traded funds is the term is, they trade off these futures. So if you see the actual standpoint, and of course you have these expiration dates right here, but if you see a standpoint of, oh, okay, so we have a really strong breakout right here and we're starting to flag, I think this can trade up to 18 or 20 on the VIX futures. A lot of these ETFs are going to follow suit. And a lot of these ETFs trade off these VIX futures. You can't trade options on these, unfortunately, but you can use these to hedge your portfolio. It's a very effective way to get exposure into volatility. So that's very important you know that. And the SVXY is a short version. So as the volatility has gotten crushed the last 2 months through the summertime, July and August, it's starting to level off. The question you have to ask now, is it going to start to pull back as volatility increases? Because this is a short version. This is an inverse ETF. So this goes up when volatility goes down, and if volatility goes up, this will come down. A little confusing, but it's really effective to trade. So SVXY, all I'm going to do here is sell the at the money call spread. So if we're trading at 72.50, I'm going to go out and pick something that's relatively rich, like the September's. There's really a couple different decisions here, but you can even go out to October 21st. We'll keep it the same month for simplicity. So if we have these different strike prices, if we're trading at 72.50, if we sold, and the liquidity is not as good here, but we could still definitely trade this very easily. I would go out and if you ever get confused, there's probabilities and things, and I try to guide a lot of my clients to make this as simple as possible. But going out and selling something that's around a 70% probability of success is a smart trading dynamic and a strategy. Also, looking at the bid-ask spreads and seeing how tight they are is important. But selling these 62 is a little low, so maybe we go up to 70. So we'll sell the 80s and buy the 85s. So if we sold the 80 call and bought the 85 call, this is the conservative trade now. So first of all, it's important that you know that this is out of the money. So as long as the volatility doesn't continue to crash, then this will definitely stay below 80, or it should. And we have 57 days till expiration on this. So we're selling an 80 call and buying the 85 as protection. We're bringing a $1.40 credit. So if you tie up the margin on this, I'm going to go ahead and show you how this trade looks. This is the conservative one. So the first one was the moderate one. This is the conservative one. And then the last one is going to be the aggressive one, which I'm going to show you here shortly. And this is the exact risk profile. So the most you can lose is right about $17.50. The most you can make is about, well, $1.40, which is $140 a contract, times 5 lots is $700. So the most you can ever make on this trade is $700. The most that you can lose is the difference of these strikes and your spread minus your credit. So basically $360 times 5 is $1,800. So you're risking $1,800 to make $700. You're making about $4.30 per day, and you have a negative 50 delta risk, which means you want this to go down because you have negative share exposure, which means you're short the stock at about 53 shares. So that's a smart trade. I like that trade. The last one that I want to show you now before we finish up is on the UVXY, which is the other ETF we talked about. Now this is an ultra VIX, so when the VIX index goes up, this goes up at a much more rapid pace. Now this has higher volatility, so you can get a lot more premium, and with that being said, you gotta be careful buying this type of stuff. I would definitely be more prone to sell a put on this or sell a put spread, like going out to October, and which is 135 on the volatility, a lot better than 118 or 131, still good too. I mean, that's definitely worth looking at. I mean, you can go and sell the September weeklies that expire the 23rd of September and sell the 18 strike, pretty tight market here. The 18 strike, you have odds on your favor, and you can bring in about $155 for one put. And depending on your margin and how your account's set up, this is a very smart this is what Warren Buffett uses and a lot of professional institutional traders and hedge fund traders to get long shares of stock or ETFs or securities, is to sell a put. All we're doing is we're selling this put option, which means we can get put into it and buy the shares at that price. So if we're trading at $20.30 and we think volatility is going to go up, we may never get put into this. We might just keep this premium, but you can keep doing this, month after month or week after week, depending on your expiration horizon. So to analyze this trade, and this is still defined risk, but this is because we're selling a put, we're not buying one. It's going to tie up a little more margin depending on how your account's set up. So for this account, which I don't have that much leverage because I like to use something for my clients inside the Options Trader Club to where more people can follow along. So an $1,800 BP effect is the margin requirement. So in essence, we're putting up $1,800 to make $157 in about a month. And this is conservative because the stock or the underlying index doesn't have to move really. It can go down a little bit. It can actually go down 10% or still be okay. And this is something that will start to accrue this rich positive theta as we get closer to expiration. So as you see, you move forward into September, middle of September, now the data's doubled, and this is something that will slowly work as you get closer and closer to expiration. So three different trading strategies, all different risk tolerances kind of built into this, because there's a lot of different traders out there, and it's all about knowing what suits you best. If you're conservative, selling a put is a smart idea, or selling multiple puts, or selling an out of the money put spread is great. Also, the one that we did, which was selling the call spread, is still the same variation of the bullish nature of volatility, but using a more kind of intricate trading strategy by using the inverse ETF through the SVXY. And then the VXX is a moderate smart trade to where we're buying and selling to mitigate the negative time value, and also have a pretty decent risk reward to where if we see a nice 10-20% increase in volatility, we could at least double our money. And these are what you can use to get exposure and trade volatility into the election. If you have any questions, feel free to reach out to me. You can reach me at my website at optiontradingcoach.com, and there's a submission form there, or you can head over to the optionstraderclub.com and get involved with our community here. We have a lot of smart trades just like this getting involved, and it's all about serving you. So thanks for your time, and I'll be in touch again soon. Take care.